I mean, Nvidia is really a generational story for now because, I mean, how many $3 trillion companies actually have doubled, so clearly Nvidia is important, but it's important because it's really one of the most important ways to get exposure to AI. And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date. And I actually think breadth is likely to increase. So for investors,
Tom Lee, the co-founder of Fundstrat Global Advisors, has been particularly bullish on Nvidia, predicting that the company is well positioned to capitalize on the growing demand for artificial intelligence, AI, and its related technologies. Lee has consistently highlighted Nvidia's dominance in AI hardware, particularly its GPUs, which are essential for powering AI applications across various industries. In recent reports, he emphasized Nvidia's role as a leader in AI innovation, with its GPUs being critical for tasks like machine learning, data analysis, and AI model training, all of which are becoming increasingly central to business operations across sectors. Given these trends, Lee predicts that Nvidia's stock will continue to outperform, with the company's market valuation potentially reaching new highs as demand for AI technologies surges. In early 2024, Nvidia's stock price surged by over 80% in the first quarter alone, driven by a massive increase in demand for its chips used in AI applications. Tom Lee attributed this growth to Nvidia's strategic focus on AI, which has enabled the company to stay ahead of competitors and maintain a dominant position in the rapidly expanding AI ecosystem. Lee's analysis points to Nvidia's cutting-edge products, such as the RTX AI laptops and various cloud-based AI services, as key drivers of its success. Moreover, Lee sees Nvidia's ongoing partnerships with tech giants and enterprises looking to integrate AI into their operations as further evidence of its long-term growth prospects. As businesses continue to adopt generative AI and other advanced machine learning technologies, Lee believes Nvidia will benefit from a sustained increase in revenue. Looking ahead, Lee has projected that Nvidia's market cap could significantly increase, potentially reaching a staggering $3 trillion, given its central role in the AI and tech industries. He believes that as AI technology becomes more ingrained in industries like healthcare, finance, and autonomous systems, Nvidia's products will be indispensable for businesses looking to leverage AI. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
I think Nvidia is one of these stocks that has become part of like a stock market lore. Almost everyone has a position. And I don't think the results and the earnings changed anyone's minds about AI and the central role it's playing in both global productivity, but also Nvidia's role. But I think the sell-off tells you that a lot of good news was priced in. I think that's why the stock fell. It didn't take the broader market down. I think that was kind of a positive outcome, and I think it just shows you that there's room for a lot of rotation, and I think that it's revealing that small caps is one of the groups benefiting from that rotation. Valuations are definitely something our clients are asking us about because, the equity markets have been rising for several years. But the idea of a rotation, I think, is grounded on a couple of things. One is that the Fed's rate path is lower, and that benefits cyclical stocks and small caps. And we know there's also a lot of cash on the sidelines, and investors de-risked because of the yen crisis and just general concerns about the summer. And so I think the Nvidia results plus the Fed in September is really the catalyst that it's going to get some investors to actually follow through with the rotation. So I think we're early because, for instance, small caps, I know people think they're expensive, but the median PE of a Russell 2000 stock is still 10.7 times forward earnings. That's compared to almost 17 times for the S&P. So the small caps have a lot of room for multiple expansion. Well, there's a couple reasons, Scott. The first is that I think markets are much more focused on inflation reports and CPIs next week and the June FOMC meeting on Wednesday. And the second, which of course we think is going to just show a continued improvement in inflation. But the second is that stocks really historically have done well in the week following the release of the employment report, rising roughly 70% of the time. And it implies roughly 70 to 80 points in the S&P. Of course, it would be better if it was a soft jobs report, and it wasn't.
Well, it's funny you say that. It would be better if it was a soft jobs report, because I think the market spent a good amount of today deciding, what it was. Was it good news is good news is bad news? I mean, if the market doesn't necessarily need rate cuts, why is a softer report better? Why can't we just be happy with good news? Labor market's strong, economy's hanging in, don't need rate cuts, and still may get them later this year.
I mean, I generally agree with you, Scott, but as you know, there's a faction of both market participants and the FOMC that view some of this data as too hot for them to be comfortable with. And I think, the more positive data points you get, the more you might actually start to see markets price in a hike. And so I think you're right. There is a Goldilocks window, but it's safer to say bad news is good news, because those actually clearly take away inflationary pressures. That dynamic is certainly at play for a couple of reasons. One, April was a down month, and I think a lot of institutional investors actually sat out May thinking April was the start of a bigger correction, so June is when money starts coming back in. But I think more importantly, since the end of 2022, I think a lot of institutions and a lot of high net worth individuals sort of sat out this market saying, hey, I'm happy earning 5%. By the middle of this year, if the S&P is up 15%, on top of missing 30% last year, I think a lot of folks are going to say, listen, I can't just sit on cash and earn 5% anymore when I'm missing out potentially on a 25% year for the S&P.
Tom Lee believes that despite the Federal Reserve's interest rate hikes, Nvidia will continue to perform strongly due to its dominance in the AI sector. While rising rates typically put pressure on high-growth stocks by increasing borrowing costs, Lee argues that Nvidia is somewhat insulated because its GPUs are central to the AI boom, a secular trend he views as resilient to broader economic challenges. As demand for AI technology surges across industries, Lee expects Nvidia to maintain its growth trajectory, even in a higher-rate environment, due to its critical role in powering AI applications in sectors like data centers and enterprise AI solutions. Lee also points out that Nvidia's solid financials, including strong cash flow and a large cash reserve, give it the flexibility to weather the impacts of Fed rate hikes better than most other tech companies. Unlike many firms that may face higher capital costs, Nvidia's financial strength allows it to continue investing in innovation and expanding its market leadership in AI. Lee suggests that Nvidia's critical position in the AI and data center markets, combined with its ability to generate robust cash flows, will help the company survive the Fed's tightening policies and thrive in the long term.
It's kind of hard to tell, especially day to day, but if I had to guess, we don't want to be in a situation where the economy is slowing so much that we've actually hit stall speed, so rates would go down. That type of economic dynamic would scare stocks. So it's almost like bad news is too much bad news. In fact, maybe that's why today's jobs report kind of fits right in the middle, because it's actually good enough to tell us the economy is still strong, as you said, but it's not enough to actually add to inflationary pressures. I mean, Nvidia is really a generational story for now, because, how many $3 trillion companies actually have doubled, so clearly Nvidia is important, but it's important because it's really one of the most important ways to get exposure to AI. And I think the AI story is, early innings, as many people talk about. It's transformational in terms of productivity, and there's a lot of use cases developing. So as much as it might feel like a one stock market, as you know, there's a lot of stocks up more than 20% year to date. And I actually think breadth is likely to increase. So for investors, there's a lot of opportunities in the second half.
Nvidia's future outlook remains highly promising, with strong growth expected as demand for artificial intelligence, AI, and machine learning technologies continues to surge. As AI becomes more integrated into industries like cloud computing, autonomous vehicles, and data centers, Nvidia's GPUs, which are essential for AI processing, are likely to see sustained high demand. Despite potential challenges like rising interest rates, Nvidia's leadership in AI-driven hardware and its ability to innovate positions it to remain a dominant force in the tech sector, with its stock price expected to continue rising as these technologies expand. Please share your thoughts in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.